Okay, picture this. President Trump just dropped a bombshell. He wants to boot Jerome Powell, the guy running the Federal Reserve, way before his term's up in May 2026. And let me tell you, the financial world is losing its mind. The US dollar's taking a beating, down 10.3% this year, its worst quarter in over a decade. Wall Street's acting like it's no big deal, but over in Beijing, they're practically throwing a parade. China's making moves, and they're not subtle. They're dumping US Treasuries like nobody's business. $194 billion worth since January, according to Reuters, the biggest sell-off since 2015. They've cut their US debt holdings to $775 billion, the lowest in 14 years, saying America's policies are too erratic, per Nikkei Asia. Meanwhile, they're stockpiling gold and rolling out gold-backed contracts. Oh, and they just opened a massive gold vault in Hong Kong through the Shanghai Gold Exchange. Foreign investors are piling in, and every dollar they skip is a power shift from Washington to Beijing. This could be the beginning of the end for the dollar as the world's go-to currency. Here's the deal. Trump's plan to replace Powell, which the Wall Street Journal reported, sent markets into a tailspin. Traders are betting on a rate cut by the end of the year, even though inflation's still high, running between 3.6% and 6% annualized, and the Fed's nowhere near agreeing to ease up. Rodrigo Catril from NAB says it's like the markets think Powell's replacement is already in charge, and they're selling off Treasury futures like crazy. Bloomberg's data shows the dollar index crashed 1.8% in just 2 days after Trump's comments at the NATO summit. This isn't just talk, it's markets jumping the gun. If people stop trusting the Fed to stay independent before Powell's even out, what happens when the new chair steps in? Foreign investors are already ditching U.S. Treasuries, and with the 10-year Treasury yield stuck at 3.97%, bonds are losing value when you factor in inflation. This hits you right in the wallet. A weaker dollar means pricier imports, everything from oil to your phone. The U.S. trade-weighted oil import index is up 12.6% this quarter alone. If this is the controlled decline, imagine what happens if things really go south. China's not sitting idle. Their offshore yuan's up 2.4% against the dollar since April. They've launched 16 new futures contracts for foreign investors, think rare earth metals and more, through the Zhengzhou and Dalian exchanges. This isn't just random, it's a calculated power play. Beijing's rewriting the rules of global finance, and their next move? It's the one nobody's ready for. Picture this. China's central bank governor, Pan Gongsheng, steps up to the mic at the 2025 Lujiazui Forum in Shanghai and basically says, "We're done playing by the West's financial rules." He's not yelling it, but the message is clear. China's building its own system to bypass the dollar-dominated setup. And they're not just talking the talk. The Shanghai Gold Exchange just opened a massive vault in Hong Kong that pulled in $10.5 billion in its first month, according to the South China Morning Post. That gold isn't just bling. It's a trust anchor that doesn't care what the Federal Reserve thinks. When the dollar starts wobbling, China's ready to pounce, and this could flip the global economy upside down. Here's the deal. The U.S. is starting to slip, not because of gold, but because of liquidity, the lifeblood of global trade. In May 2025, U.S. goods exports tanked 5.2% with industrial supplies and capital goods hit hard, per the Bureau of Economic Analysis. Even crude oil exports, which the U.S. has leaned on to flex its energy muscle, dropped 7.1% month over month. That's a gut punch to the narrative that America's still the king of energy trade. Meanwhile, China's playing it smooth, not slapping on new tariffs, but quietly cutting orders for U.S. semiconductors and aerospace parts. BCA research says this non-tariff strategy is smarter than sanctions. It's a slow-burn decoupling that's putting real pressure on American manufacturing jobs. The result? The U.S. merchandise trade deficit ballooned to $11.6 billion in May. With exports drying up, the U.S. is leaning harder on domestic spending, which is already showing cracks. China, on the other hand, is out there locking in influence without firing a shot. They're pushing Yuan-based trade deals across ASEAN and Africa, flipping market share like it's a chess game. Posts on X are buzzing about this, with some claiming China's digital yuan system, tied to their cross-border interbank payment system, CIPS, is already processing 3.6 trillion yuan in Q2 2025, up 21% year over year. That's not a pivot. It's a full-on systemic shift. and it's challenging the U.S.-controlled SWIFT system head-on. If demand for U.S. goods doesn't rebound, America's not just losing trade volume, it's losing global clout. Then there's the U.S. Treasury market, and it's not looking pretty. The Congressional Budget Office projects the federal deficit will hit $1.9 trillion in 2025, forcing the Treasury to auction $3.2 trillion in debt this year. But buyers are getting picky. Bloomberg's Lydia Boussour points out the latest 20-year bond auction had a bid-to-cover ratio of just 2.09, the lowest since 2011. Japan, the biggest foreign holder of U.S. debt after China, slashed purchases by $38 billion in 3 months, blaming losses from hedging a weaker dollar. Meanwhile, China's redirecting its trade surplus into yuan-based lending across ASEAN, building a financial web that doesn't need U.S. treasuries. If foreign governments stop soaking up U.S. debt, who's left to keep the dollar afloat?
Now, let's talk about your wallet. Inflation's biting, and it's not just random. In Q2 2025, Walmart raised prices on over 1,200 items: food, clothes, electronics, blaming Trump's expanded tariffs, which now hit $344 billion in goods. Bank of America's consumer tracker shows grocery baskets are up 8.7% year over year, while household discretionary spending dropped 3.1% in May. Walmart's CFO, John David Rainey, told CNBC these price hikes aren't temporary. Retailers are protecting margin. The U.S. Bureau of Labor Statistics adds that real hourly wages fell 0.5% in May. So even if your paycheck looks bigger, it's buying less. Here's the kicker. Chinese exporters are dodging the U.S. market, offering yuan-based contracts to lock in demand from ASEAN and Middle Eastern buyers. That means the higher prices you're seeing at the store are partly because China's flexing its pricing power, and they're just getting started. If this keeps up, the dollar's reign as the world's reserve currency could take a serious hit. China's gold-backed moves and yuan-based trade deals are rewriting the rules, and the U.S. is struggling to keep up. It's not just about trade numbers. It's about who calls the shots in the global economy. And right now, China's warming up for the next round. The U.S. dollar's dominance is showing cracks, and the numbers don't lie. The IMF's COFIR database reveals the dollar's share of global reserves has slipped to 58.3%, the lowest since the euro's launch, down from 65% in 2016. Meanwhile, China is quietly rewriting the rules of global finance. According to Standard Chartered's Emerging Markets Outlook, Yuan reserves, while only 2.7% of global reserves, have surged 72% in 5 years. 23 central banks now hold yuan-denominated assets. It's not a flood, but a steady drip that's hard to reverse. As UBS strategist Rohit Arora put it, the shift to the yuan is sticky. Once countries start, they rarely go back. In May 2025, China and Indonesia signed a $100 billion bilateral swap deal, enabling trade in LNG and coal to settle in yuan, bypassing the dollar and euro entirely. Switzerland and Brazil have also begun adding yuan to their foreign exchange reserves. These aren't isolated moves. They're part of a deliberate strategy. The dollar's power hinges on trust, but that trust took a hit in 2022 when the U.S. froze $300 billion in Russian central bank assets. Eurasia Group's Dan Wang called it a warning signal to the world. China responded by slashing its U.S. Treasury holdings by $13 billion over 18 months and rerouting sovereign wealth fund operations through Hong Kong and Singapore. Beijing's also offering incentives, like partial loan forgiveness for Belt and Road partners settling trade in yuan. IMF data shows 67% of China's new lending in Africa now defaults to yuan. On June 26, 2025, the Shanghai Gold Exchange launched 2 yuan-denominated bullion contracts and opened an offshore vault in Hong Kong, clearing $2.3 billion in trades within 48 hours. Unlike London's LBMA system, these contracts are settled physically in Asia, priced in yuan, and open to foreign investors using non-dollar collateral. Hong Kong's Treasury chief, Christopher Hay, summed it up. Gold is a tool for monetary diversification. As the world's top gold producer and consumer, China is building a robust alternative to Western precious metals markets. ING analysts warn that China's infrastructure, paired with capital from de-dollarizing nations, could challenge London's $140 billion monthly gold market within 5 years. The dollar isn't collapsing tomorrow, but its scaffolding is being dismantled piece by piece. While the US grapples with internal debates and market volatility, China's issuing gold-backed Yuan contracts, and central banks are shifting toward Yuan over US Treasuries. Capital is moving, not loudly, but relentlessly. What's next? The next 90 days could be critical. Will the dollar hold its ground, or will it lose more terrain? One transaction at a time. All right, that's a wrap on today's deep dive into the global financial chess game. What do you think? Will the dollar hold its ground, or is the yuan's rise unstoppable? Drop your thoughts in the comments. I'm dying to hear what you make of this. If you found this breakdown helpful, give that like button some love, hit subscribe, and tap the bell so you don't miss our next video. Thanks for watching, and I'll catch you in the next one.